Good morning, and how are you today? We want to today look at budgeting, and that's the topic I want us to look at today. And would look at a little definition of budget. Probably I'll share with you on our WhatsApp platform some notes on this budgeting, and but I'll use this particular platform to probably do a few calculations, which I think it's good for all of us to look at. I don't know whether my pen will write over here, but I think I can do some writing. Yeah, then we'll be able to clear it at the end of this. So I want to welcome you for our class today, and I'm saying today as we start that budget has like three main objectives. Budget has three main objectives. One is to help to control costs. Two, budget also helps to control performance. And lastly, three, it helps to control finance, all the finances that we have, and obtain what we are calling financial stability. Financial stability. So those are the main objectives of drawing up a budget. And a budget is a financial statement that is prepared and approved prior to a defined period of time of the policy to be pursued during that particular period for the purposes of which that particular budget is provided or made at the end of the day. It may include parts of the budget. It may include the income, expenditure. It may include the income and expenditure, and it may also show how capital is employed. It may also show how capital is employed. A budget also has a budget control that at the end of the day, once a budget has been established, that particular budget should be able to allow us compare the actual versus the budgeted, what has already been projected, so that you can be able to get to know how to control your expenditures and things that you're doing at the end of the day. Apart from budgeting control and other things, it also has some advantages. Some of these that I will want you to have a look at. One of the advantages, it helps in planning in advance and a continuous basis because it becomes part and parcel of the institution. The second advantage is that it helps coordinates and correlates all the efforts in an organization. But some of these, I think, as I share the notes, you will be able to look through at the end of the day. Third advantage that this particular budgeting have, because it reduces wasteful spending. It reduces wasteful spending, amongst other several advantages that you'll be able to look at it. Of course, it also has some disadvantages. You look at it. But of interest now, I want to look at the purposes of a budget. The purposes of a budget. And it has the following purposes. Budgeting has the following purposes. Let me try illustrate. I wanted to again just ensure that having all of them together. One, it coordinates all the different departments. So it acts as a coordinator of departments. Two, helps communicate policies and targets. Communicates policies and targets. Three, it establishes a system of control. Establishes a control system. Four, management is forced to look into the future instead of making ad hoc decisions. So management is futuristic instead of making ad hoc decisions. Number 5, it motivates employees by involving them in the budgetary process. It helps the employees by involving them in the budgetary process. And of course, creating challenges that they intend to achieve. And lastly, number 6, it helps evaluate the performance of top management. It's an evaluator. It helps evaluate the performance of top management so they can be able to check through at the end of the day. There are different types of budgets. There are different types of budgets. So we have types of budgets. There are different of them. One is what is known as the master budget. Master budget. Of course, we'll just list them. We have a sales budget. We have a production budget. Production budget. We also have material purchases and stock budget. Material purchases and stock budgets. We have the cash budget, and then we also have a rolling budget. And then we have I think that is the types of the major types of budgets that we have. Of course, budgeting also has different types of methods of budgeting, and one of them is called the zero-based budgeting. Zero-based budgeting. I think there'll be some notes there for us to read. Its advantages and its disadvantages. We have flexible budgets. Flexible budgets. We have fixed budgets. And how they are done, I think we'll be able to get some notes into how that particular thing is done. But of major interest for our class today is the cash budget. Of major interest for our class today is the cash budget. So this is the one that we will be looking at today, the cash budget. The cash budget, it's the major one that we want to deal with. So what does this cash budget deal with? What does it entail? What does it really look through at the end of the day? And that is what we want to discuss. And hopefully by the end of our discussion today, we shall have gotten a few glimpses and be able to work out on a few examples on this particular type of or a way of doing budget. So we are saying that this is probably, let me just pick up a sheet here. We are saying this is probably the most fundamental budget of all the budgets together. Why? Because it brings together all the other factors in cash terms, and of course it indicates the project availability of cash at a particular period. It even shows when funds are likely to be low. It also points out at which additional funds that are required to be able to provide an institution on how they can be able to roll out their budget. And we'll be picking up this by looking at this particular example. This is what we want to look at. So let's just get this. Human Company Limited. Let me try Human Company Limited on January 1st. On 1st January was expected to have an opening cash balance. Human Company Limited on January 1st was expected to have an opening cash balance. So probably we'll have our opening cash balance. opening, sorry, I think I'm writing a lot. Opening cash balance of around, let me just write the figures on this particular column here. Let me put that so that I have the figures there. So we have an amount in Kenyan shillings, so let's talk of 30,000. And he had the following budgeted sales. So we have budgeted sales, and budgeted sales he has provided for us in months and of course in terms of amount. So we have months here. So we have months there. So we have the month of November, the month of December, let me just abbreviate them, January, February, March. The figures here in Kenyan shilling are 80,000, 90,000, 75,000, another 75,000 there, and that is okay. Sorry, these ones ought to have, let me just bring them down. The first one was month and not the amount. Then lastly here, another 80,000. So we are told analysis of the record shows that debtors settle according to the following pattern. So he sells these things on credit, and the settlement of debtors has a pattern which has already been established. The settlement of the debtors are as per the following pattern. I think debtors, yes, as per the following pattern. So this is what the debtors are doing. They pay 60% within the month of sale. So let me just put it here, within the month of sale. Within the month of sale. Then the other 25% is paid the month following. And then lastly, the remaining 15% is paid, of course, the month following again. That means if sales are made in January, 60% are paid in January. Then another 25% are paid in February. Then the remaining 15% are paid in March. So that is what this settlement of the debtors pattern looks like. So we're talking of 60% within the month of sale, 25% the month following, then 15% the month following. So it's like the first month, the month of sale, they pay the major bulk, 60%. The following month, after that particular month, they pay 25%. And then the third month, as in after the month of sale, they pay the remaining 15%. They had this extract from their purchases budget. That's why we said the cash budget brings it's a conglomeration. It brings out all the other budgets together. So they had this extracts from the sales budget. So the extracts of the purchases budget, not the sales budget. Purchases budget is as shown below. So we have December again, then January, then February, then March. So this is how their purchases are looking like: 60,000, 55,000, 45,000, and 55,000. We are given this additional information that all purchases are on credit, and past experience shows that 90% are settled in the month of purchase and the balance settled the month after. So we have a settlement also of, let me just copy this down somewhere here. So, but this is a settlement of purchases. A settlement of, so let me not of debtors, but of purchases. That is the ones that they purchase. And here they are saying it is 90% within the month of purchase. The month of purchase, and then the remaining 10% the month following. So they don't have anything remaining for the 15% there. Then they've also given us out of the additional information. They're telling us wages are 15,000 per month, overhead at 20,000 per month, including 5,000 for depreciation, which are settled monthly. Attention to detail here again. What we are saying, wages are 15,000 per month, overheads are 20,000 per month, and that 20,000 for overheads includes 5,000 for depreciation, and they are settled monthly. Taxation of 8,000 is settled in the month of February, and the company will receive a settlement of an insurance claim of 25,000 in the month of March. Then you are required to prepare a cash budget for January, February, and March. So let me just repeat that last line there. That taxation is to be settled in the month of February. So in the month of February, they are paying taxation. Let me just put it here. So taxation of 8,000 shillings. 8,000 shillings. This is paid in the month of February. Then they will again receive an insurance claim, and the insurance claim that they are expecting to receive is 25,000 shillings, and this will be received in the month of March. That will be received in the month of March. Then you are required to now prepare a cash budget for the month of January, for the month of February, and for the month of March. For the month of January, February, and the month of March. So let me try see how we can be able to start doing our workings. So I'll have our workings there. Our workings will be there. So we have, we want to, what is required for us? Let me just put another one figure, another Excel table here. What is required for us is a cash budget. Cash budget, and of course we are doing it for the month of January and February and then March. Of course, the beauty of working in Excel, we can link out a few issues. That's why we can get now back to our workings and try see. So we have first for the month of January. January has now 3 things that will be affecting January. So let me just write here January. January is affected by 3 issues. If you, let's say for example, we were saying how the debtors are making settlements to their claim, you will find that the cash that comes in, 60% we are told it is within the month, 25% the month following, and then 15% the month following. That means in January, we will be receiving, in fact, the cash that we will be receiving in January are cash for the month of January. Let me just write it here, will be 60% of that particular sales. The cash that will also again come, these are sales. Let me just write them here. These are sales. So this is the cash that is coming in for the month of January. Still in the month of January, we will receive cash that relates to the previous month following is December. Then we will also be receiving cash from November. So what percentage will we be receiving for the ones in December? We will receive 25% of the sales which were done in December. Then again, we will be receiving 15% for the sales which were done in November. Why? Because in November, when the sales are done in November, they would pay 60% in that particular month of November, then they would pay 25% in the succeeding month of December, then they would pay 15% in the month of January. This is what is already mentioned to us in terms of how the debtors are doing their settlement. Let me repeat that. The sales which were done in November, 60% is received in November. The sales which are done in November, 25% is received in December. And lastly, 15% of the sales which are done in November will be received in January. So January will have 60% of its sales. It will have the 25% of the sales of November, and then it will have 15% of the sales which were done in in November. So if we look at the sales which are done in the month of November, we are told, and we have the figures here, so I can just do the sales here. And the sales there for November is 80. Let me just say equals to that's the beauty of Excel, equals to that figure there. Then the ones that were done in December equals to the figure is there, 90,000. Then this one equals to the figure is there in no that we have that is January is 75,000. So that is the sales which are done there. So we are multiplying to get the actual cash that we are receiving in January, and we have said January it is 80%. 60% of that figure there. Sorry, I'm missing some part of it here. Sorry, I'm missing some part of here. The sales which are done in January, are 75. Yes, 75. The sales which are done in December are 90,000. Yes. Then the sales which are done in November are 80,000. Are 80,000. Are 80,000. So if we do our 60% of the sales which are done in January, because that is what the sales that we did in January, we have 45,000 there. Of course, Excel can allow you to just copy this one and you paste them along the way. Then you have that all the cash that we are receiving, just doing an auto sum, is 79,500. Is 79,500. So when you come to our cash budget, let me just mention this. Ensure this is our cash budget. So our sales there. Of course, let me just start because we were told there was an opening balance. So let me have an opening balance. The opening balance in January. Let me just make this a little bit bigger. The opening balance there was 30,000. Let me just make this in shillings. So that is 30,000. Then now our receipts from sales, our receipts in January, I can put an equal sign, then I go back to our sheet where we're doing the working. Our receipts there will be 79,500. Then I click there, enter. Then it will give me that. So that is our sales for the month of January. Of course, I had from our additional information, there will be some insurance claim that we will be receiving. So I'll leave a space for that, and it's not coming up in January, so I just say all the totals for our cash receipts in January is 109,000. Probably can underline these ones and ensure we have bottom up there. So we have those figures there. Of course, what we are told, we are making some payments. It's a cash budget that has sales and cash coming in and payments. So part of the payments are purchases, which we will be making. And of course, there are some wages which we are paying. There are some overheads And overheads, remember we were told that overheads are 20,000, but within the overheads there's a depreciation of 5,000. And depreciation is a non-cash item, and we are doing a cash budget, so we have to eliminate all the non-cash items. So if our overheads were 20,000, so it will be 20,000 minus the 5,000 for depreciation. So that will be 15,000. We can the same again will be on the month of February. 20,000 minus 5,000. You can as well just copy paste Control C and then you paste it there to have your figure of 15,000 for the month of March. Of course, we know that our wages, we have been told it's 15,000 every month. That is what we are paying every month. I can be able to populate that 15,000 every month. That is what we are paying for our wages. Then there's a moment of something that we'll be paying, and is this taxation, which we are told from our question. We are not paying it in the month of January, but we will be paying it in the month of February, and the figure there is 8,000. So our total payments, that will be the total payments. It's a total of all this. You can just either say equals to sum, and you just sum up all this. So that is you select that area where you are summing up from. So of course that one is 30,000 for the time being. I'll make this ones bold. I'll also do figure there, just be able to ensure this. But there are purchases which we have yet to determine to be able to know the actual things over here. Then we will be talking about our closing balance. Our closing balance, and our closing balance now will be equals to the 109 in terms of actual cash received minus the total payments. This particular closing balance, I will come back to it, is what is giving us the opening balance in the month of February. We will have an opening balance here, but that opening balance will come from this figure here. So we will see how we are linking it up. Then again, the same thing, the opening balance of March will come from the closing balance in February. So if we were to have again April, the opening balance here will be coming from the closing balance in the month of March. Again, if there were May, the opening balance here will come from the closing balance in the month of April. So we'll be able to look at that together. So let's get back to our workings, and then we clear the sales. So we have determined the sales for the month of January. Then our sales for the month of February, we will be having the actual figure for the sales for the month of February. We will be receiving sales for the month of January, part of it, and then we will be receiving sales for the month of December because of how our debtors settle our payments. The debtors settle our payments. They are settling them 60% within the month, 25% the month following, and 15% the month after. So in February, we'll be receiving 60% for that particular month, 25% from the month of January, and then 15% of the sales from the month of December. So if you look at it nicely, then the February sales, I can again put equal sign. Our February sales, we were told, was 75,000. Of course, our January sales is also 75,000, and our December sales is 90,000. So if we do now the multiplication where we are multiplying 70% of that, and then I can copy this down. So someone is sending me a text there. So our totals figure there, if I add them, our sales for the month of February is 77,250. Then if I pick in the month of now March will also have sales from that particular month of March, we will also have cash coming from the previous month of February, and then another cash coming from the other previous month, the month of January. 60% we have said will be from the month of January, 25% from the previous month, and then 15% from the month of January. So what are the sales in January? In March, the sales in March are 80,000. The sales in February are 75,000, and then the sales in January, we are also told they are 75,000. So if again we do the multiplication, and then we now get the actual cash that comes in, I can just copy that, drag it down, then I get my totals there, and then the figure will be 78,000. So these are all my total sales. So when I come to our cash budget, I just say now, let me just punch them in. So my cash receipts for the month of February, I just say equals to, I rush back to my working, it is 77,250. Receipts for the month of March, I just say equals to, then I copy paste from the month of March, and that is the figure that I have. So I already have now all my receipts. I was also told how much the insurance claim is coming in. We are not receiving it in January, neither are we receiving it February, but it is coming in the month of March, and the figure there is 25,000. Of course, my totals, I can begin running them up so that I have the actual figures there. And also for my expenses, I can rush them up. So I have, and then I can do a balancing figure there. And remember I said that 79,000 is our closing balance here, but before we calculate the figure for purchases, of course we are yet to get the figure for purchases. So this particular figure here, the closing balance, will be the opening balance for February. So let us look at how the purchases working will look like. So these are working on sales, and now let me look at the working on purchases, the working on purchases. So how the purchases are looking like. And of course, you're looking at the purchases in January, and we are told that January has, this is the actual cash that we are paying. How we normally settle our payments is that we were told here that settlement of purchases, we are paying 90% within the month of purchase and then 10% the month following. So that means if we are paying cash in the month of January, we are paying for January and part of December. When it comes to, let me just pick it, when it comes to February, again, we will be paying for February and the part the previous month of January. Then when it comes to March, we will be paying for that March and the part of February. So what are we doing in January? We will be paying 90% of that purchases in January and 10% of that which we had not cleared in the previous month. The same thing will again happen in February, 90% and 10% of the previous month, 90% and 10%. Again, then in March, this will be 90% and this will be 10%. So what are the purchases in the month of January? The purchases in the month of January, we are given here, it is 55,000. The purchases in the month of December, we are given the figure there is 60. The purchases in the month of February is 45,000. Of course, for January, now we know is 55,000. The purchases for the month in March, the figure there is 55,000. Then the purchases for the month in February, the figure there is 45,000. So if I do the multiplication so that I get the figures there for my actual purchases, I can just copy them down. I can just copy these ones down now. Then my total purchases for January, itakuwa 55,000. My total purchases for February itakuwa 46,000. And lastly, my total purchases for the month of Which month is that? For the month of March will be 54,000. So I can just get now back to my cash budget. Now I have the figures there. For January, I just do an equal sign. The figure there is 55,500. For February, I just copy paste the figure here. I've worked it is 46,000. Then lastly for March, we have worked the figure there is 54,000. The figure there is 54,000. So when you look at it now, let me now remove these particular illustrations that I was using. So when you look at it now, you will definitely find that just like I was saying, that the closing budget for the month of January now is 24,000 because we have cash of 109, we have payments of 85,000. You subtract that, you get 24,000. This should now become the opening figure for the month of February. So we just say an Excel formula with this one equals to this one. We just copy paste it there. So we have the figure there. So once you add our balance, opening balance for the month of February, 24,000, add to the receipts of 77,250, you'll get a 101,250, subtract all the expenses of 84, you have a balance there of 17,250. This closing balance for February is the opening balance for March. So we just say this equals to that closing figure there. So our net cash balance as at March is projected to be 36,250, to be 36,250. And of course, that now marks our end of cash budget. That is how you do a cash budget. I can make that into bold. So the cash budget picks in several budgets. Of course, we have a sales budget here together. We have a purchases budget here together. We have other overheads budget or other expenses budget brought together on the cash budget. So of course, if you remember how we started it, we started looking at of course, the figures there that we were given in terms of our workings, the sales and how the sales patterns are working at, then the purchases and how the purchases payments were working through. Then we balance them off against our expenses. Of course, we have to have attention to detail. We are told an insurance claim of 25,000 is coming in the month of March. And then, of course, there was a tax element of 8,000 that was to be paid in the month of February. Then, if you remember on overheads, it was overheads less depreciation. Overheads less depreciation. And why were we subtracting depreciation? Is because depreciation was, it's not a cash item. It is normally a provision that we make. So there is not actual cash that is going out. With those many remarks, I will share the notes also for the budget for our purpose of reading. I hope this will suffice for our class today, and I wish to say, may our good Lord bless you. As it is, I will also share the link again for this on our YouTube platform so that you can be able to again review and listen to it. May our good Lord bless you and meet you again.